So, hello and welcome to this interesting webinar. Friends, while debt funds are back on track in terms of YTM, still there is a lot of uncertainty around debt funds in terms of interest rates, inflation, and other global factors. So, to help us understand the future course of debt funds, today we have with us Pranay Sinha, Debt Fund Manager, Nippon India Mutual Fund. Pranay brings with him over 15 years of experience in fund management. So, without wasting a single minute, let me welcome Pranay. Pranay, welcome.
Thank you, Nishan. Thank you for having me over and to explain our view on the markets and on the debt fund.
Okay. So, Pranay, as you know that there is a lot of uncertainty around interest rates, inflation, and other global events continue to exist. So
Yeah,
let me start by asking the most common questions in everyone's mind, that what is your near-term outlook on the debt market?
sure. As you said, as your question was also very revealing in the sense that you talked about global uncertainties, right? So, broadly, markets can be divided to two parts. One is that locally we are seeing a lot of stability, be it currency, be it fiscal, be it inflation, be it growth, and globally we are seeing a lot of uncertainty. So there is some kind of dichotomy going on between what we are seeing locally and what we are seeing globally, and that's the state of the debt market right now. Locally, growth is, while not spectacular, it's decent. Inflation is high compared to what we used to see from period 2017 to 2020, but it's still manageable. It's nowhere near what the levels which we are seeing globally. Fiscal is high, but it's under control, and most probably we'll see some improvement there. On the external front, we are suffering the most in terms of the trade deficit. However, that should improve in coming months. And currency is, while it's has underperformed against the US dollar, if you map it against a basket of all other currencies, you will find that it has been an outperformer. So net on a bigger basket of trade weighted basket, we have been an outperformer for last 6 months. So that's the India is basically an island of stability in a global world, which is been very unstable. What are the areas of instability? Uh, in many of the developed markets, the growth conditions are very tight, and they are expected to get worse as the developed market hike rate even further and tighten conditions even further. Inflation remains a worry. US last week the data came in. This week the data came in, and it again was above 8 inflation number. UK was above 9. So all in all, it is a very volatile world outside. US, there is a risk of 100 bips rate hike when the rate meeting happens later this month, and similarly UK will have a 75 bips, and Europe similar. So that's the world in a nutshell, and the Indian debt market in a nutshell. While we are very comforted by the local stability, macroeconomic stability, we are obviously very cognizant of whatever is happening outside, and that remains a patch of worry for us in the debt market.
Okay. So, Pranay, last couple of years were not so good for debt funds. So, in
Yeah.
such a scenario, why do you think that debt funds will make a strong comeback from here?
As I said, particularly last year, what we saw that there was a catch up which yields were playing to the reality. So when inflation was spiking in US and in India for last 2 years, and US for last 1.5 years, the rates are still low. So basically, market had a dichotomy because the reality were worse, and the central bankers both in US and in India hadn't caught up to the reality. So the market participants were caught somewhere in between, because should they look at the macro numbers, or should they look at whatever the central bankers are saying? And hence that's why you saw a period when rates were lower than what market reality would have forced them to do it, and hence we saw a period of spike of rates in a very small period of time, compressed period of time, which caused obviously a bit of uncertainty in terms of return for the fixed income investors. Now what you will find is that that period of dichotomy is over. Market obviously recognizes what the global conditions are, and they are priced it well. But more importantly, the central bankers are also cognizant of the challenges they are facing, and they have tailored their policies based on that. So that's why the yields which we are seeing is reflective of the uncertainties and risks which we are facing. And since the market, is, and particularly the government security market, is very well versed in terms of discounting all the negative and the positive of the market, and hence the pricing of the market is very well. And it's obviously, as you will see, most of the government bonds are in this seven handle. So the price market is pricing the risk very well, and the absolute levels are also very good. So that heralds a good period for the fixed income investors.
So where do you see yields curve moving?
So as I said, given the stability which we are seeing locally, and that would account for maybe 60-70% of the factors which should govern our yield curve, we feel that market is pricing in all of these very well, and hence we will, unlike last year when 10-year moved from 6% to 7.5 in a matter of 1 year, this year at 10-year at 7 quarter right now is, I think, pricing in all this very well. And if local factors were the only contributing factors, then probably I would have said that 7 quarter is a fair level, or plus minus 5, 10, 15 basis point, which obviously is nothing compared to the walls which we saw last year. So these would have been fair levels in that sense, and wouldn't have seen much walls in yields going into next year. Obviously, as I said, the point of uncertainty remains how the global macros are going to shape up, and that might cause some amount of volatility. The war, the inflation, how the global central bankers are behaving, this can cause volatility on both sides, and hence that remains a risk. Otherwise, I think local rates are poised to be stable and at these absolute high levels.
So, Pranay, which category of debt funds should an MFD look at currently?
So, as I said, since it's going to be uh, the curve has become very flat, and you are going to see some amount of decent amount of stability in terms of rate and yields, and there are not going to be lots of walls going ahead unless something happens globally. Then distributors should match their investment horizon with the kind of duration they are matching. So if we are looking at 1.5 years, you should kind of horizon. Then you
Mhm.
should look at the short-term fund or the banking PSU or the corporate bond fund. If you are looking at a 3-4 year kind of horizon, then you should look at the dynamic bond fund, our dynamic bond fund, which is again a sovereign bond fund. And obviously a investor who's looking has a time horizon of 7-8 years and beyond, and which we have recommended through all kind of cycle. The evergreen fund is the Nivesh Lakshya fund.
So why are you so optimistic about long duration strategy, and how do long duration funds score over long term target maturity funds?
Sure. So why are we optimistic about the long duration strategy is a simple fact that uh, if you see compared with the last 7-8 years, the long end bond is fairly priced right now. Last 7-8 years, the average yield which we have seen for the 30-year bond has been at around 740. So currently, 25-year bond at 740 is fairly priced. This was not the case for last 2 years, right? You saw the 30-year bond going to as low as 650 levels. So that's a big advantage. Second advantage is that this kind of fund, while the entry point is important, what you will find is that the entry point is not the full determinant of the return. So even if the rates go up higher from here, you won't be negatively impacted by the rates going higher. The simple reason is that when you're holding this fund over a period of 7-8 years, then the reinvestment uh, makes sure that you're not going to be, so the reinvestment happens at a higher level, and this makes sure that you're not going to be hurt by the rates going up. So this fund, you will find if you do a proper simulation of the returns over a long term period, after 7-8 years of holding, the returns are not very different from the current YTM which you have entered.
So Pranay, Nippon India has Nippon India Nivesh Lakshya Fund in the long
Yeah,
duration category. And in fact, value
yeah.
research data shows that the fund has outperformed its peer and benchmark despite being a passive fund. So what are the
Yeah.
things that have contributed to this?
So the most important thing for this fund is that the conception and the idea is the most important thing.
Mhm.
The idea is very simple and very well executed. So what happens is that this becomes market agnostic beyond a point, and hence due to the steeper yield curve, you will be beating the any fund which has a lower duration running a lower duration strategy, or which is running a volatile duration strategy over a long period of time. So because of these factors, we are outperformed over a long period of time. Obviously, we have done this. The data is only for 4 5 years, and this fund has been in existence for only 4 5 years. So our recommendation to all investors has been to enter this fund for a period of more than 7 8 years. So this is not enough period to make comprehensive judgment on what it will intend for a longer period. However, we have done run this strategy for say simulated this fund say from a 2006 to currently on a bond which was 30 year in 2006, and which rolled down over a period of time. And what we have found is that the returns have been in line with what we were expecting.
So ideally, which category of investors should look at this fund?
This fund is very useful for a person who is planning who has a multiple target, which are as follows: who is looking to have hold investment in a fund which is doesn't have a credit risk, which
Hmm.
doesn't have liquidity risk, and who is willing to hold this fund for over 7 8 years. Uh, so that kind of guy, and obviously his aim is to beat inflation over the those time period. So that kind of guy will benefit from this fund most of all, and this is broadly tallies in line with the kind of retirement planning people are going to do. So this fund is very apt for, but not exclusively for them, but it's very apt for that kind of planning. How do you benefit? First of all, it's a sovereign only fund which only invests in government of India securities. So there is no amount of credit risk here. Second, the liquidity is there's no liquidity risk, because unlike a fixed deposit or any kind of bond which you will buy on your behalf, you are going to profit. You're not going to face any liquidity risk. You can have a T+2 redemption at any point of time. Third is that the reinvestment risk is much lower, as this fund has a higher time horizon. So just to compare, if you keep on investing in a 3 year fund which has you have to reinvest every 3 year, then you face the reinvestment risk if the rates go down after 3 years when your fund expires. So the reinvestment risk is also not there, and obviously you are getting the benefit of tax benefit due to the inflation indexation which is happening, and that is a huge benefit that this fund will have. So because of this 3 4 factors, this fund is very apt for those guys.
So Pranay, how is Nippon India Nivesh Lakshya Fund different from other such funds in the market?
This fund is very different in the sense that what we are targeting is to give investor benefit from beating the inflation over a long period of time. We are trying to minimize the reinvestment risk which investors will face. We are providing obviously the liquidity in terms of we are not going for any credit type of credit risk in this fund, which obviously helps because if the kind of securities are there is are government bond, which is both highly liquid and credit risk free. Because of this, and obviously the third last part is that we have followed a very disciplined strategy. So if you see the composition of the fund, it is almost 98% the securities which we have described, which we used to invest in 30-year bond in 2017, and now we are investing in 25-year bond. So it's a roll down kind of fund, and we have adhered to this strategy over a period when the rates have gone higher or lower. This implies that we are very disciplined, and there's no kind of intervention in terms of from the fund manager in the thought process, which was as in the way it was initially conceptualized. So because of that, this fund has the potential and has outperformed, will outperform in a period of uncertainty and walls.
So great. With that, we have come to an end to this interesting discussion. Thank you so much, Pranay, for such an insightful discussion and your time.
Thank you, Nishan. Thank you for having me over.
And finally, I thank each one of you for being such a wonderful audience. Have a great day, guys.
Thank you. Thank you, everyone. Have a good day.